Moving averages are among the most popular and widely used technical tools in trading. Because they are used by so many traders, it's worth having them on your charts to know what other traders are looking at. Often, in a trading strategy, traders are using more than one moving average, often a combination of a slow and a fast moving average. In this video, I will follow this approach and spin it in a slightly different way to give you a fresh perspective relating to the use of moving averages in your trading. A moving average strategy can help you not only to identify the average trend, but also the trend strength. For this reason, you can use more than one moving average, a slow moving average of 55 period and a fast moving one of 21 period. Why these particular numbers? Because 21 and 55 are Fibonacci numbers, but you can backtest and change the values of the averages as you like. You just need to learn how to read price action using this approach. So, 21 and 55 moving averages. This setup will provide a clearer picture of the trend strength on a slower and faster time frame. First, let me point out that this is not a crossover strategy. While such a strategy for moving averages is perfectly acceptable and valid for some traders, I prefer to think slightly outside the box and pay attention to a specific repetitive pattern when combining a slow and a fast period moving average. Remember that moving averages indicate conditions in the market. They are not surefire signals that will tell you when to buy or sell. We will use them as a tactical component within our trading method. The main goal behind using a shorter period moving average with a longer one is simple. We are looking for both perspectives in making a more informed decision. While the 21 shorter term moving average will be located more closely to price, resulting in more touches, the 55 moving average gets touched less frequently during a normal trending market. However, there is a different perspective to following the patterns of a slow and a fast moving average in relation to price action, and I call it the contraction expansion principle. The contraction expansion principle is derived from the Bollinger Bands indicator. This principle is not based on the moving averages crossing over, but rather the distance between the two moving averages as an indication of the strength of the trend. When in a strong trend, the price will pull the 21 moving average with it, which in turn will diverge further away from the 55 moving average, causing a larger gap between the two moving averages. This is an expansion. As price pulls back or transitions into a sideways pattern, the moving averages will close in together, often creating a contraction. We want the price to bounce right off this dynamic zone and break out into a trend. This example illustrates how the two moving averages behave when the market is trending. We have a dominant downtrend displaying frequent but short pullbacks. Notice how the distance between the moving averages is fairly consistent to reflect the smoothness and consistency of the trend itself. When the market does pull back, it bounces fairly accurately from the 21 and 55 dynamic zone, a price action pattern I noticed is very common during strongly trending conditions. In this other example, notice this extended pullback and the behavior of the moving averages. We have here what we call the contraction of the two moving averages, caused by an extended pullback into the downtrend. Essentially, the 21 moving average gets pulled back with the price near the 50 moving average, narrowing the gap between the moving averages. If the trend is strong enough and the other factors permit for the trend to continue, we can expect this pattern of moving averages to release price back in the direction of the trend. Keep in mind that, like most technical indicators, moving averages are lagging, which means that they react to price rather than price reacting to them. That also means that the contraction of the moving averages isn't the cause of the resumption of the downtrend, but it's rather an effect of price resuming the trend. Here we are looking at an uptrend that slowly transitions into sideways market action. Each of the pullbacks into the uptrend cause a slight contraction of the moving averages, resulting in price shooting back up sharply. But as we approach potential key resistance around the round number, an extended pullback doesn't result in price shooting back up sharply. You should note that as price tried to resume the trend after the last pullback, it stalled at the crossover point of the two moving averages and actually reversed back down. This is usually a very strong indication that we are either entering a period of sideways action, preparing for a deeper pullback into the dominant trend, or entirely reversing the trend. So this is the first step in our strategy. We analyze price action to find the contraction in the moving averages, essentially a pullback into the dynamic support or resistance area determined by the two moving averages. By watching how price behaves as it pulls back from the dynamic zone, we can analyze the momentum in the current move. Remember that after a pullback to this area, we are looking for a sharp move back in the direction of the trend. Next, we need to add other aspects into our analysis. As said before, when looking for a resumption of the trend at the dynamic zone, it helps to analyze if the trend has room to proceed. Does the dynamic zone also line up with a round number or a major horizontal support or resistance zone? Is the trend headed into a key swing high or low? Answering these questions will help you to build an overall understanding of the market and can help give important signs to fine-tune your entries and exits. The final step is to trade a breakout after the price resumes in the initial direction and the price was unable to break below the dynamic zone of the two moving averages. So we chase a breakout, a momentum move, in the direction of the trend after we identified strength in the market, meaning that the price found support or resistance at the dynamic zone. This means we have buying power in an uptrend or selling power in a downtrend at the dynamic zone formed by the two moving averages, and we aim to ride the momentum wave. But we need a breakout. We want a trendline breakout or a swing breakout. In this example, we have the dynamic zone, which basically acts as a magnet, because when price is too far away from it, it tends to pull price back to this zone. Then, as the price was unable to go lower, which is key in our strategy, as we want to see strength and buying power, we also have a breakout play here, out of this wedge pattern or triangle pattern, indicated by these lines. So we have a price action based entry. With this strategy, knowledge of candlestick patterns and price action is very important. This is because you will be looking for reversal candlestick patterns on this area. Patterns such as engulfing candlesticks and pin bars are ideal as a trade entry. Because the strategy is based on a dynamic zone in the form of the 21 and the 55 moving averages, we will also use these dynamic areas as our basis to set our stop loss, below or above it, depending on the trade we take, in this example below it. This is a conservative stop. A more aggressive stop is below the most recent correction. As for target, I aim for at least 1 to 1 to 5 risk-reward ratio. Here is a short setup. We have the contraction zone here, tested several times by the price. Observe that the price was unable to go through this area. This means we have active sellers in this zone, ready to push price back down. We enter short after the breakout of this range. You might ask, why do we have to wait for a breakout? Why not entering short when the price was in the contraction zone? Well, because in real time, we don't know if the price will indeed reject the dynamic area. It might push through the zone and go the other way. We need a clear sign or confirmation that price wants indeed to go lower. So don't try to gamble and enter earlier without breakout confirmation, because that's not the point of this strategy. So to be crystal clear, wait for the price to return to the dynamic zone. The two moving averages must not cross each other during this pullback. And after the price rejects the dynamic zone, search for a breakout in the direction indicated by the two moving averages. The best tip I can share with you is to always pay attention to the slope of the 55 moving average. The slope of the 55 moving average can tell a lot about the strength of the trend. When the 55 moving average shifts from strongly pointing upwards during a bull trend to going sideways, it can provide early warning signals about a shift in sentiment. So pay attention to it. Here are several examples of valid trades. This is not a perfect strategy. You will encounter losing trades, and for this reason, you could add your personal spin on it, additional confirmations or other types of analysis. Just make sure you don't overcomplicate it and stick to the main concepts of the strategy: rejection of the dynamic zone and the momentum move in the direction of the trend. As always, if you learned something new and found value, Leave us a like to show your support, subscribe to our channel and click the bell icon to stay in touch when we release new videos. Until next time.